wealthbranch.com.
3 ways to value a company's stock. Imagine you're a real estate appraiser, and you mostly use 2 main methods to evaluate real estate. 1, the comparable sales approach, where you compare similar properties in a neighborhood, then calculate the price per square foot of comparable properties to determine the value of your property. 2, the income approach, where you calculate a capitalization rate of a property by calculating the present value of the property's future cash flows. Like a real estate appraiser, our job as an investor is to determine the value of a business. Evaluating a company is like real estate, but a little more complex. To help us as investors, let's get a little help from the Dean of Valuation himself, Ashwath Damodaran. If you don't know about Ashwath, you need to check out his YouTube channel and buy his books. He's a longtime professor of finance at the Stern School of Business at New York University. We'll be following part of his curriculum and adding information from great investors. Here's the Dean of Valuation himself explaining the 3 methods of valuation.
When I first started teaching valuation 26 years ago at NYU, I made the mistake of assuming that everybody else was as interested in valuation as I was. In hindsight, that was a bad mistake. Most people don't believe in valuation. By most people, I include most people who do valuation for a living. But they do it. They do it to cover their rear end. They do it because it's their jobs. Let's look at the 3 broad approaches that there are to valuing a business. And there are only 3. The first I'm going to call intrinsic valuation. In intrinsic valuation, you value a business, you value a company based on its fundamentals, its cash flows, its growth, its risk. Discounted cash flow valuation is the most common tool used for estimating intrinsic value, but it's not the only one. But the key in intrinsic valuation is it's all about the business. The second approach to valuation I call relative valuation. And as I describe it, it's going to sound familiar. To value an asset in relative valuation, you look at what similar assets are being priced at by the market right now. And once you find them, you use that as your basis for valuing this asset. Think about it. If you look at an equity research report, what do you see? You see a multiple, right? Price earnings, EV to EBITDA, price to book. And you see a bunch of companies. And what the analyst is saying is, look at these companies and look at this one. Based on how these other companies are being valued, I think this company is cheap or expensive. Those 2 approaches to valuation by far dominate all of valuation, and we'll talk about which one is dominant, but there's a third and final approach to valuation. The third approach to valuation, and this is perhaps the only new and perhaps sophisticated aspect that's new to valuation, is applying option pricing models in the context of valuing these assets that have contingent cash flows. What are contingent cash flows? Well, this asset will have value only if something happens. So if you're a biotechnology company, you have a patent working its way through the pipeline, it'll have value only if you get FDA approval. You're an undeveloped oil reserve company, those oil reserves will have value only if oil prices go up beyond a certain level. So collectively, you can take valuation approaches and break them down into these 3 basic approaches. Underlying each approach, though, is an assumption about how markets work, or better still, how they don't work. Each of these approaches assumes that markets make mistakes. Saying, why do we need that assumption? If markets never made mistakes, there would be no point to valuing publicly traded companies, right? The market price of the company would be the best estimate of the value of the company. So every one of these approaches makes an assumption about market mistakes, but they all make different assumptions about how markets make mistakes and how those mistakes get corrected.
Business valuation techniques. When appraising a business, you're trying to find the intrinsic value of a company. The intrinsic value is often calculated by using the dividend discount model or the discounted cash flow model. We'll cover both models and how to find their relative valuation in this course. Option pricing models will be covered later. Let's go through a quick introduction of these approaches. 1. The dividend discount model. The dividend discount model, abbreviated as DDM, is a way of appraising a stock based on the value of future dividend payments. Many analysts use the Gordon Growth Model, GGM equation, when trying to find the present value of future dividends. Famous economist Robert Shiller explains the Golden Growth Model.
So, Professor, I was hoping we can go through the idea of the Gordon growth model and kind of how that relates to what we've learned in CAPM.
Myron Gordon, a half century ago, merely told gave a formula for the present value of a growing quantity. Suppose we have an asset, let's call it land, that is producing revenue for you every year, and the revenue is growing in value. So it produces X the first year, then it produces X times 1 plus a growth rate the next year, and then it produces X times 1 plus the growth rate squared the next year, and then it does that forever. So this is now it's time 0, and then we have time 1, time 2, times 3, time 4, it would be 1 plus g cubed, etc. I say this might be land, because land, assuming that it's managed properly and doesn't get depleted, will yield a crop every year. And as time goes on, the crop will be worth more, partly because demand for it probably goes up in a growing economy, and partly because of technical progress. And we're going to assume this land goes on growing like this forever. So the question is, what do you pay for this land at time 0? Okay, Myron Gordon, he's famous for this formula, principally, is that the present value equals X all over R minus G, where R is the rate of discount. What he's saying is that the present value is X all over 1 plus R, that's this first term here, plus X times 1 plus G all over 1 plus R squared, plus X times 1 plus G squared all over 1 plus R cubed, okay? And if you calculate, you can show that that infinite sum reduces to this simple formula, as long as G is less than R.
Have you ever heard of it or used the Golden Growth Model? Please comment below. 2. The Discounted Cash Flow Model. The Discount Cash Flow Model, abbreviated as DCF, for many investors is the main calculation to find a company's intrinsic value. DCF figures out the present value of future cash flows. We'll cover how to calculate the DCF later in this series. Let's check out what Professor Buffett has to say about the discount cash flow method.
If we could see, looking at any business, what its future cash inflows or outflows from the business to the owners or from the owners would be over the next, we'll call it 100 years, or until the business is extinct, and then could discount that back at the appropriate interest rate, which I'll get to in a second, that would give us a number for intrinsic value. In other words, it would be like looking at a bond that had a whole bunch of coupons on it that was due in 100 years, and if you could see what those coupons are, you can figure the value of that bond compared to government bonds if you want to stick an appropriate risk rate in. Or you can compare one government bond with 5% coupons to another government bond with 7% coupons. Each one of those bonds has a different value because they have different coupons printed on them. Businesses have coupons that are going to develop in the future too. The only problem is they aren't printed on the instrument, and it's up to the investor to try to estimate what those coupons are going to be over time. As we have said, in high-tech businesses or something like that, we don't have the faintest idea what the coupons are going to be. When we get into businesses where we think we can understand them reasonably well, we are trying to print the coupons out. We are trying to figure out what businesses are going to be worth in 10 or 20 years. When we bought See's Candy in 1972, we had to come to the judgment as to whether we could figure out the competitive forces that would operate, the strengths and weaknesses of the company, and how that would look over a 10 or 20 or 30-year period. And if you attempt to assess intrinsic value, it all relates to cash flows. The only reason for putting cash into any kind of an investment now is because you expect to take cash out. Not by selling it to somebody else, because that's just a game of who beats who, but by, in a sense, by what the asset itself produces. That's true if you're buying a farm. It's true if you're buying a business. And the filters you described, there are a number of filters which say to us, we don't know what that business is going to be worth in 10 or 20 years, and we can't even make an educated guess. Obviously, we don't think we know to 3 decimal places or 2 decimal places or anything like that, precisely what's going to be produced. But we have a high degree of confidence that we're in the ballpark with certain kinds of businesses. The filters are designed to make sure we're in those kinds of businesses. We basically use long-term, risk-free, government bond type interest rates to think back in terms of what we should discount at. And that's what the game of investment is all about. Investment is putting out money to get more money back later on from the asset, and not by selling it to somebody else, but by what the asset itself will produce.
3. Relative valuation or comparable company analysis, CCA. If you've ever worked with an excellent real estate agent, they probably gave you a comparable analysis report, or the comps for short. In the report, it showed you what similar houses were selling for in that neighborhood. A financial analyst or investor does the same thing with stocks. The analyst performs what is called a comparable company analysis, CCA, also known as public comps, or comps for short. Let's check back with Ashwath as he explains relative valuation.
The second approach to valuation is relative valuation. In relative valuation, you value an asset based on how similar assets are priced. You've given up on intrinsic valuation when you do relative valuation. You say, I don't know what the intrinsic value is. I'm going to let the market tell me. And if you break down relative valuation, here's what you're going to see. You're going to see a scale measure of price. What do I mean by that? You might not be able to compare the values of individual companies because some are smaller, some are larger. But if you divide that value by earnings or book value, in other words, you use a multiple, you are essentially comparing numbers which are comparable. The second ingredient you need for relative valuation is you need to find other investments that look just like yours. That might be easy in some cases. It's difficult when you're talking about companies. Find me a company that's similar to Microsoft or Apple. It's tough to do, right? So what you will often find is analysts defining something as comparable, then waving their hands and saying, you know what, they're probably not that comparable. Which brings me to the third step. You need to control for differences across these investments, growth and risk and cash flows. So find a multiple scaled version of a value, look for comparables, control for differences. What kind of mistakes do you assume markets make when you use relative valuation? You actually assume that markets are right on average, but that they're wrong in individual companies. And that they're wrong in individual companies, that those mistakes will get corrected sooner rather than later.